Tax stuff you've got to know. You've got to know this. I've been preaching this for years and years and years. I got my Bruins hat on. Go Bruins, even though the freaking sports suck. Who cares about the stupid Olympics, but whatever. Don't forget to curb stomp the like button if you're in a bad mood. Curb stomp that like button, all right? And if you're in a good mood, you can give it a smooch. Smooch the like button. We're going to try a different tactic than fondle. Yeah, fondle's a little bit creepy, right? So curb stomp the like button or smooch the like button, depending on the mood you're in. All right, so I was working my man, we'll call him Leo. All right, so Leo, good guy, crushing. He's got a large brokerage account. So the bulk of his retirement accounts, but the bulk of his assets is in a brokerage account. Lots of NVIDIA stock. So he's done quite well for himself. But he does have an IRA, about $1 million in an IRA. And interesting though, he's only like in the mid 60s, so he doesn't have to take RMDs for about 8 years or so. All right, but over the next 10 years, they want to be living large. Leo and his wife, Jane. I got to come up with a different name. Joni, Jane, Doris. There you go. Leo and Doris. All right, so they're going to be living. They're going to be living large in the next 10 years or so before RMDs kick in. All right. So we're trying to do some planning for mitigation of, you can't eliminate taxes, but to minimize them, what he's got to pay. So his cost basis on his brokerage, he's got about $2 million in a brokerage account. Cost basis is about $1 million. All right. So we talked about specific identification, average cost, and all this stuff. How you can actually go into your Schwab or Fidelity or Vanguard account, whatever, and just say, these are the shares I want to sell. You can go LIFO, you can go FIFO, you can go average, a million different ways you can do that. So we talked about that. But the software that we're going to use here, Right Capital, it can't get that specific because it's not actually tax planning software. All right. So I want to show you something though. The software has him selling his brokerage account. All right, because that's what we're going to fund. We're going to live off our brokerage account in order to have is basically to avoid taking our IRA money. We're going to live off the brokerage account instead because that will be taxed more efficiently. Why? Because long-term capital gains are always taxed better than ordinary income, regardless of what tax bracket you're in. Long-term capital gains are always lower than ordinary income. So if you're in the 0 to 12% tax bracket, long-term capital gains are zero. If you're in the 15%, I forgot what it was, 450, I can't remember. But if you're in the above the 12% tax bracket, it can be taxed up to 15, and even if you get higher, I forgot what the number is, but to 20%. And if you get above 250 and married filing jointly of income, then any interest income, capital gain income, non-dividend, what's the word? Any passive income is subject to the 3.8% Medicare surtax, the net investment income tax as well. All right. So again, if you have 250 or more of income, any passive income is subject to 3.8%. All right. So you could be in a 15 to a 20 to as high as a 23.8% capital gain rate, depending on what your income is. Still lower than ordinary income. In this case, so we want to sell stocks to keep his income tax lower. All right, so that's what we're doing. So in this case, we're going to show you here. We're like, oh my goodness, but look, he's in a 22 to 25% tax bracket, or 24 right here. He's in a 24 to soon to be 28% tax bracket. Look at that. Oh my goodness. So he's getting crushed. But I'm going to show you something, amigos. Check this out. Don't get confused by this, all right? Here's his effective tax rate. You can see right here, his effective tax rate for the federal government is only about a 15% effective tax because you got the state of New Jersey where he lives. He's got about 15% in federal government. So he's in a 24% tax bracket, but his effective tax rate is only 15%, if even that. So check this out. So we're going to show right here here's his capital gain right there, $126,000 of capital gain, all right? Now, I don't recommend he takes that big of a capital gain. We want to use, in this case, probably most likely average cost, all right? But it doesn't matter. He can, that would be my recommendation. Even if not specific identification, use average cost. But he has $126,000. He doesn't need to have that much money. But the software, for some reason, is saying that's what your capital gain is going to be. That's fine. So he's got a little bit, he and his, what's her name, Doris, have a part-time income. They got some taxable interest because they got a large brokerage account. They got some dividends they got as well. All right. They also have a small pension, $25,000, plus this large capital gain. All right. So you can see their total income is $260,000. That is their total income. Their AGI is 260. So 260,000 is their total income. Their AGI is 260. But Their taxable income is only $224,000 because of standard deductions, and this is 2027. The personal exemption will come back, so they got about $36,000 of standard deductions and personal exemptions. So we add up all this, it gives us 260 as our AGI. Subtract this right here, we have a taxable income of $244,000. But you only pay $27,000. What? $27,000 on $260,000, which means they're in a 27 divided by 260 equals what? 11%, a 10.3% effective tax rate. 10.3%. So even what Right Capital was showing you in terms of that chart was wrong, because what Right Capital shows you is their effective tax rate after the standard deductions, whatnot. But effective tax rate is really how much your gross income is subject is you paying tax on. To get my dog because he's loud. Is he in a 24% effect tax? Is he in a 24% marginal tax bracket? 100%, he is. But his effective tax rate is 10%. Effective tax rate is 10 because of all the capital gains in there. Should he do Roth conversions? No, because every $10,000 of Roth conversion, he'd lose $2,400. Should he take money out of his IRA? No, because every $10,000 he'll lose $24,000. Even though his effective tax rate is only 10%, his marginal tax rate is still well above that. It's still more than twice, almost 150% more, whatever that is. 1.5 times that. See how different? It's why you got to know this. Why a brokerage account is so important. Because don't forget, even this right here, dividends is still taxed as long-term capital gains. It's taxed very, very favorably. And some of that will be tax-free because the first amount up to the top of the 12% tax bracket is tax-free. I hope that makes sense. So check this out. You can see they're going to be living large on their brokerage account. This is when they still got some ordinary income, some earned income from part-time job. But then you can see it's flat, man. Now this is when he dies, his wife takes over, but still, just flat. Look how flat that is. Isn't that fantastic? Even when RMDs kick in, they still got over $1 million in required in the IRAs. So even when RMDs kick in, it's just flat. A little bit of a jump again when he dies. But look at that, just flat, man. And yet their tax, let me show you again. Tax bracket is way up here, and then it drops down here to 12%. You can see it's right on that 12%, their tax bracket, right above there a little bit, right on that 12% tax bracket. So we don't want to do any Roth conversions here because there's such a high bracket as it is. A 24% tax bracket would just make them pay $2,400 on income you'll never have to pay $2,400 on, ever. You never have to pay that kind of tax again, ever. Why do that? Doesn't make sense. And they shouldn't do Roth conversions here either. Why? Because they're riding right there on that top of the 12. The green is the top of the 12% tax bracket. They're riding right there. So to do a 50,000, well, just 10,000 simple Roth conversion here is going to cost them 22%. Well, actually, it's going to be 24% in taxes. Again, right here. Doesn't here it's going to cost them. They're in this. 25. Don't do any Roth conversions here because it's cost 25%. It's crazy. No, it's going to cost them 28%, 24 to 28. But here, if they do Roth conversions, it'll cost them 22%. It'll be 24% soon. I know it's confusing, but still, they're over the 12% tax bracket if they do Roth conversions. So not only would they not paying 12%, they'd be paying double that, actually significantly more, about 60% increase in taxes just to do Roth conversion here. So you got to know how the ordinary income tax brackets work, your effective tax brackets are marginal. So again, ordinary income tax bracket. To do Roth conversion here is stupid because you'll be converting into a tax bracket that's double what you're currently in. Don't do that. To do Roth conversions here is stupid too because even though they're only in a 10% effective tax rate, their marginal income tax bracket is still, whatever that is, 24%, soon to be 28%. You gotta know this stuff, man. That's why it's so important to build up the brokerage account. Build it up. Now, if you're making, I was talking to a guy the other day, he's making like $700,000-$800,000. He should defer as much as he possibly can, for sure. Because he's not going to be making that when he's retired. But man, if you're making, $80,000, $90,000 a year, man, I'd be take advantage of your 401k match. Absolutely, I'd still put it all in a Roth, and then I'd be building up any excess I put in my brokerage account. That brokerage account, man, is a sound of freedom, baby. All right, God bless. Love to hear your thoughts. We'll see ya.